Stop scrolling right now, because what happened overnight in silver is the kind of move that looks totally normal on a chart until the day it absolutely isn't. And that day might be coming faster than anyone expects. We just watched silver sprint like a madman toward that 3-digit wall that everyone in the precious metals world has been whispering about for months. The legendary $100 level that separates the boys from the men in this game. This isn't just any random round number we're talking about here. This is the psychological barrier that turns calm, boring silver markets into absolute chaos and separates smart money from dumb money in the blink of an eye. Right as silver got dangerously close to that level, the market did exactly what it always does when somebody big is trapped on the wrong side of the trade. It slammed the brakes so hard, it felt like a car hitting a brick wall at 80 miles per hour. If you're currently holding silver positions, thinking about buying into this madness, or even just trying to understand why the same boring metal can feel dead for years, then suddenly turn into a headline-grabbing machine in just a few weeks, this breakdown is exactly what you needed to see today. I'm about to walk you through what that sudden overnight price hit likely signals for the bigger picture, what the quiet indicators underneath the surface price action are absolutely screaming at us right now, and why the $100 level matters way more than just being another round number on your trading screen. Before we jump into the deep analysis, do me a quick favor that actually helps more than you realize. Smash that subscribe button for MarketPulseUSA if you're getting even a little bit of value from these detailed market breakdowns. We're pushing hard toward 50,000 subscribers in the next 30 days, and your single click actually creates more momentum than you think. Plus, it helps us reach more people who need to understand what's really happening in these markets. Also, we're now dropping exclusive member-only content on a regular basis with a dedicated research team working behind the scenes to build these deep dive market updates only for you, our special Market Pulse USA family members. If you want access to that premium level analysis that goes way beyond what we can share publicly, hit that join button right now, or use the link down in the description to get instant access. Last night's action wasn't just another case of normal market volatility that we see every day. It was a clear message sent from the big institutional players who actually control the direction of this market. Silver pushed aggressively toward that crucial psychological line in the sand, and then suddenly a massive burst of coordinated selling hit the market in a way that didn't feel like normal profit-taking from retail traders. It felt like a desperate defensive maneuver, like somebody with serious skin in the game absolutely needed that price to back away from the dangerous edge before things got completely out of control. Here's the part that most casual observers completely miss when they're just staring at price charts. When silver gets smacked down hard like that at such an important technical level, you can't just look at the price drop in isolation. You have to dig deeper and examine what happened in other related markets at the exact same time, because while the paper price was getting hammered, the cost to borrow actual physical metal, what we call the lease rate, spiked dramatically. That's a weird combination that tells a much different story than what the surface price action suggests. And it's exactly the kind of contradiction that smart money pays attention to, while everyone else gets distracted by the scary red candles. If this market was truly well supplied with plenty of available metal and sellers were calm and confident, you typically don't see borrowing costs jump through the roof at the exact moment that coordinated paper selling shows up on the screens. A normal, comfortable silver market has lease rates sitting low and quiet, almost sleepy, just fractions of a percent, like background noise that nobody really pays attention to until something important changes. But when lease rates suddenly jump hard and fast, especially during a price drop, it's the physical market whispering that actual metal is getting tighter than most people realize, creating a dangerous disconnect between paper and reality. Think about this contradiction carefully. The paper market is screaming, "Sell everything now," while the physical borrowing market is demanding, "Pay up big time if you want actual metal." And those are two completely different realities colliding in real time. That collision between paper weakness and physical tightness is where the real story lives. And it's exactly what separates successful precious metals investors from the ones who get their faces ripped off by following the wrong signals. For years now, one of the strangest and most important features of the silver market has been extreme concentration, not a diverse group of traders creating natural price discovery, but dangerous concentration among a small number of powerful players. A tiny group of massive institutions has carried short positions that are unusually large compared to most other commodity markets, and I'm not saying that to sound dramatic or conspiratorial. I'm stating it because concentration fundamentally changes everything about how this market behaves. In a normal commodity market, price discovery is messy, but broadly distributed among lots of different participants with lots of different motives and lots of independent pressure coming from all directions, creating natural balance. In a concentrated market like silver, price can still move up and down, but it moves through much narrower channels of control, which means the chart can look clean and predictable while the actual positioning underneath is anything but normal. So when you hear some technical analyst confidently say, the pattern clearly shows silver should do X next, you have to ask the critical question, Is that pattern working in a genuinely free market or a carefully managed one? Because those are absolutely not the same game. And the rules that work in one situation can completely destroy you in the other if you don't understand the difference between natural and artificial market behavior. Silver sits in this strange and strategically important intersection of money, industry, and geopolitical strategy that most investors never fully appreciate until it's too late to position properly. On the industrial side, silver is literally everywhere in modern technology. Electronics, solar panels, medical equipment, high-end manufacturing. It's often a small component in complex systems, which makes it invisible until you try to replace it and suddenly realize you can't. Then there's the part that makes people uncomfortable to discuss openly in polite company: defense and military demand from high-performance systems that don't choose materials based on good vibes or political correctness. These critical systems choose materials based on hard properties like conductivity, thermal stability, and reliability under extreme stress. And when the environment gets truly dangerous, you reach for the material that actually works, not the one that's cheapest or most politically acceptable. That's exactly why silver shows up in places and applications that the average retail investor never sees or hears about, creating demand that's much more strategic and price insensitive than most market participants realize. Here's where margin becomes the silent killer that wipes out more silver traders than any other single factor. When the metal starts moving aggressively, the leverage opportunity looks incredibly tempting to traders who want to maximize their profits. A relatively small amount of capital can control a large amount of metal exposure, making everyone feel smart and early, and like they've discovered some secret that others missed, right up until the exchanges suddenly change the rules overnight. Then the exchange raises margin requirements without warning, and suddenly that same exact position needs significantly more cash behind it. And if you don't have that extra cash sitting around, you don't get to hold through the inevitable dip. Instead, you get forced to sell into the dip at exactly the worst possible moment, and that forced selling pushes the price down even further, which triggers more margin stress for other leverage players, creating a devastating cascade effect. That cascade is exactly what big, cash-rich institutional players absolutely love, because they can step in calmly and buy everything at fire sale prices, while emotional retail traders are being forced to panic sell their positions. When you're not selling by choice based on your analysis, but selling by force due to margin calls, that's precisely when the smart money steps in to scoop up quality assets at heavily discounted rates. Those terrifying cliff-like drops often end at the exact moment that the last of the forced sellers get cleared out of their positions, and then the price snaps back aggressively like a rubber band that was stretched too far. It's not random market action or some mystical technical pattern playing out. It's straight-up systematic redistribution of wealth from over-leveraged hands to patient capital with serious money and no time pressure. Picture the whole dynamic like a giant sponge sitting underneath the silver market. Every single time the paper market dumps aggressively to scare retail investors, that sponge quietly absorbs the selling through physical demand that doesn't flinch at scary price action. Now here's the cliffhanger that's hiding inside that sponge analogy. If the sponge keeps absorbing more and more metal while the paper market continues painting whatever price it wants on the screens, this can only continue as long as they can actually source real metal when serious buyers demand physical delivery. That brings us directly to delivery stress, which is the part of this story that matters most right now for anyone trying to understand where this market is heading next. Paper games work perfectly fine as long as nobody actually asks for the thing that the paper is supposed to represent. The moment too many players say, "No thanks to cash settlement, I want the actual metal delivered to my vault," the entire structure of this market changes fundamentally and permanently. Lately, we've been seeing clear signs that more participants are choosing physical delivery even in contract months, where historically delivery demand is much quieter than normal, and that behavioral shift matters enormously. When you see lots of contracts standing for delivery instead of just rolling forward or taking cash settlement, you're looking at real capital making a clear statement. I don't trust paper promises, I trust metal in my hands. One of the cleanest stress indicators that most people never learn about until they've been burned badly is market structure. Specifically the relationship between spot prices and futures contract pricing. In a comfortable, well-supplied market, futures contracts trade above spot prices because you're paying for time, storage, insurance, and the simple mathematical fact that money has a cost and risk has a price. When that normal relationship flips and spot prices start trading above futures prices, you're seeing a market that's willing to pay significantly more to have the actual metal right now, rather than promises for delivery later. That's not normal market behavior. That's urgency. That's distrust of the system. That's the market essentially saying, promises for future delivery aren't good enough anymore. We need the real thing immediately. Here's what should absolutely stop you in your tracks. While Western paper pricing continues getting slapped down during these coordinated attacks, the premium for physical metal in key Eastern markets has remained persistently elevated for months. We're talking about persistent premiums of several dollars per ounce. where physical silver is consistently valued significantly higher than what paper markets suggest it should be worth. This creates a simple but brutal arbitrage mechanism. If you can buy silver exposure cheaply in Western paper markets and somehow turn that into actual physical value in Eastern physical markets, you've created a powerful vacuum that sucks metal from west to east. Every single dip in paper price becomes a golden opportunity for physical metal to flow eastward, and once that metal moves to those markets, it doesn't casually wander back to Western vaults when paper prices recover. The $100 level isn't some magical final destination where this story ends. It's actually a critical checkpoint where the market will test your resolve, fake you out with false moves, and try everything possible to make you quit before the real fireworks begin. Markets fundamentally run on trust, and when that trust starts to erode, people's behavior changes dramatically. They start demanding physical delivery, paying higher premiums, and stop caring about paper market liquidity entirely. Here's the contradictory truth that messes with most people's heads. Short-term caution about volatile price swings and long-term bullish conviction about the fundamental setup can absolutely coexist in the same intelligent investment approach. If you're actively trading short time frames, you absolutely must respect volatility and manage risk accordingly. If you're building long-term wealth through physical accumulation, you respect fundamentals and manage your emotions through the inevitable scary periods. I'll leave you with this major cliffhanger. If delivery stress is really building the way I think it is based on all these signals, there's one specific event that would change absolutely everything about this market, literally overnight. It's not a dramatic headline or a specific price print that everyone's watching. It's a failure to deliver situation where a major participant simply cannot provide the physical metal they are contractually obligated to deliver to buyers who demanded it. Drop your honest thoughts in the comments. When you see silver drop $10 or $15 in a single week, do you immediately think this is definitely the top and I should sell? Or do you think this is probably setting up something way bigger and I should pay attention? Your instinctual gut reaction to that question matters way more than any fancy technical analysis you'll ever see on a price chart, because it reveals whether you understand what's really happening beneath the surface of this market.